and Mr. Menzies. Can you tell me what is the average loan size of 7A loan programs that you have made in the last 2-3 years?
Yes, Madam Chairman. We've only been in the SBA lending arena for 2.5 years, so we're relatively new into this. But since our inception, our average SBA loan size for 7A is $48,000.
48.
Yes, ma'am.
Mr. Menzies?
Chairwoman, I don't have an average per se, but the range of loans have been from. Okay. Chairwoman, I don't have an average, if you will, but the range of loans that we've made have been from about $25,000 up to about $700,000. So I can think of a loan that's $235,000, but that would be the range of loans.
Okay. Some in the previous panel that we had, and some advocates are asking for an increasing of the maximum size on the 7A loans by as much as 2.5 of the current size to $5 million from 2.5. Have you seen any real demand for loans this large from small businesses, or if this is something that is more likely to benefit large banks that took TARP money?
We have not seen loan demand, and I have no knowledge of member banks that have seen loan demand at that $5 million level. Our belief would be that $3 million should be more than adequate.
Yes, ma'am. Our position is pretty much the same. We have not seen an increase in loan demand for those size of loans, so we feel that the amount at this point would be adequate at this point in time. But we're relatively, again, new into this.
Okay. Ms. Galliet, by most accounts, the need for investment has grown steadily over the past decade and is currently higher than at any time in the past. However, for years, investing capacity in the SBIC program has gone unused. Will the changes in the proposed legislation enable the SBIC program to grow and meet the need for capital?
I think so. I feel that one of the challenges for the SBIC program, it's the front end and the back end. The front end, the licensing process is so time-consuming and cumbersome that good managers are turned away. And at the back end, once you've raised a fund, we've raised our first, our second, and now our third fund, we are going to be forced out of the program because once you've achieved success, you become too big for the cap. It's not that any individual fund is larger, nor is it that we are funding larger businesses than we have historically, but the average life of a fund is 10 years. And so most successful fund managers are going to be managing 3 funds. You're going to have your newest fund, your fund that's basically hit the 4th year, which is almost the conclusion of the 5-year investment period, and then your oldest fund, which is in its 7th or 8th year, which is almost fully harvested, but isn't quite harvested. And in order to survive and keep capital moving out to communities and small businesses, you need to raise that next fund. And so what happens is the funds are forced out of the program. They raise their next fund, a much larger fund, because of the economies of raising funds. Raising capital is also very difficult. So when you're forced to raise all of your capital from private investors, you're going to tend to raise a larger fund and invest in larger businesses because it's a lot of work to invest in small businesses. Making a $2 million loan is in many cases more work than making a $20 million loan because those companies, they need the technical assistance. They need our expertise. They don't know how to work with the banks. They don't know how to increase lines of credit. And we spend a lot of time on that, which the larger mezzanine lenders don't have to do.
And would you say that the proposed language on the expediting relicensing program is crafted in a way that protects SBA?
I believe it is. I think that clearly you need to be a proven manager. You need to have had a couple of exits. I think it's 3 exits in the proposal. You need to have a business plan that's substantially similar to your prior business plans and the same core group of investment managers, so you can't have changed your focus or your team. And there's always a provision for the administrator, for whatever reason, to reject that licensee if there are extenuating circumstances.
Thank you. Mr. Sekula, could the proposed capital backstop program containing this legislation help credit unions deliver more financing to small firms?
Yes, Madam Chairwoman. I think that the backstop would help more small, at least from the credit union perspective, it would allow more smaller credit unions to be able to get in and start offering funds easier. And then, of course, with the continuation of the SBA doing a lot of the administrative work, then there's not the burden of trying to hire and obtain staff and retain staff. Because from a credit union perspective, we have to have 2 years required member business lending training before you can become a business loan officer. So this will allow those who don't have that current staff on hand to be able to do that and capitalize on what the SBA backstop program would offer.
Ms. Dodge, the proposed Small Business Early Stage Investment Program will permit participating investment companies to repay the SBA funds at the same time as other investors when the company exits its investment. What are the advantages of this repayment structure?
Madam Chairwoman, I think that that is critical. As I mentioned, we were a participating securities SBIC, and in fact, as we looked at that program, I think the difficulty with that was that it did not participate in the upside. And what private investors and institutional investors have learned in the venture capital is that when we look across venture capital performance, the top tier way compensates, and the multiples that they earn for compensates, and by capping the upside and not participating the same way that the private investors do, both in terms of timing and in participating in the full upside, their economics were sort of doomed to failure. And so I think by aligning, the venture capital industry has shown over time that it is an attractive asset class, and that makes sense.
Thanks. Mr. Menzies, a frequent criticism of the ARC loan program was that these loans were burdensome for lenders to make. And what are some ways that the paperwork burden for ARC loans could be reduced while keeping the loans safe for banks like yours?
Chairwoman Velazquez, community banks make relationship decisions. They aren't in the production business. We don't use computers to credit score and simulate the repayment of a loan and run it through a big production model. So one vehicle would be to allow community banks to use their standard C's of credit, character, capacity, capital, collateral, coverage, and conditions, and make those judgments the way they make judgments, and feed them into the SBA program without the level of paperwork that's currently required in the ARC program. Another clear benefit of this program would be to expand some of the definition of the use of the program. If I understand it correctly, it can be used to fund payments, if you will. But there are situations where individuals in small businesses have used their working capital to make payments. They've depleted their working capital to make those payments, and that working capital needs to be restored at the favorable terms that are available in the ARC program. That would be extremely beneficial if that was incorporated in this legislation.
Thank you. Mr.